Greg Torres with the Global Rewire podcast here with my co-host Fabio Nattalucci. Fabio, I think today's guest is going to be very interesting for listeners and especially investors. His name is Paul Adams. He's a managing director at Andersen Consulting, which is a unit of Andersen, our parent company, and so it's kind of a sister to the institute. Paul leads a practice that helps companies identify, protect, and evaluate intangible assets. Often the crown jewels of a company that are not always visible or or easy to see. So, Paul, let's start this way. In one of your slides, you had Apple Computer, and you noted that design prowess is one of its intangible assets. This is more than their ability to make something functional. It's about their ability to make something cool, something that's easy to use and actually is good to the touch. So maybe to kick us off, give us a working definition of what an intangible asset is.
Great question. I think actually, the simplest definition for an intangible asset, the one I find that actually most resonates with people, is it's everything inside the business that has value that you can't drop on your foot and is not currency, right? So that's an easy way to think about it. Everything in the business that's valuable that you can't drop on your foot. There's technical definitions, like if you go to IAS 38, there's a technical definition of what an intangible asset is, right? It's an identifiable non-monetary asset without physical substance, and it's got a number of other criteria associated with it. But the key point is here, these are highly valuable assets that exist within the business, but they have a non-tangible quality to them. And that's probably the easiest starting point.
What are some examples of companies in recent years where there was a lot of intangible investment going on? Companies curate, invest, and try and develop this, even though you can't really touch it, right?
If you look at where companies have gone and where investment has gone over the last 45 years, virtually every company today is an intangible asset company, right? So if we go back to 1975, intangible assets accounted for about 17% of the value of the S&P 500. If we fast forward to today, it's about 90%, right? So there's been this massive inversion, essentially, of corporate balance sheets. Almost all value is now contained within intangible assets rather than tangible ones. And if we look at the top 5 companies, for example, the portion of intangible asset value is about 98, 99%. If we look at most startups, it's almost 100%. If we look at, companies like ChatGPT, etc., it's almost all intangible asset value. Virtually every high growth, high value company today is completely dominated by intangible assets.
Why is that the case that they have become so central to modern business creation? And then a subset of that is like, can you give us a sense of like the cross-country differences? Like how much of this it's just the US phenomena, how much it's a Western Europe phenomena, China, emerging markets? What's kind of difference do you see there?
Yeah, absolutely. So the real driver fundamentally for this is that companies, what changed between 75 and 2025, like what exactly went on is, it's a function fundamentally of the way the accounting standards work and also the development that has occurred in the economy. If we look at the accounting standards, they basically say ignore intangible assets, right? So they say, okay, typically intangible assets are off balance sheet. They literally just don't make the balance sheet at all. Or they go on under goodwill. So you can acquire a company and you pay more than net tangible asset value for that. That portion that is more than the net tangible asset value is called goodwill. And we put it onto the balance sheet as a big amorphous blob, and nobody really knows what's inside it. It can be depreciated down. It cannot be depreciated up. Or the third way in which intangible assets will be treated is occasionally they do make the balance sheet and they go on at cost. And cost is a terrible measure of the value of an intangible asset because there's really no correlation between cost and value. So that is very different than with physical objects. So, for example, the desk in which I'm sitting at, there is a definitive relationship between the inputs that went into my desk, and the plastic and the metal and the glass and so forth, and the value of the desk, right? Based upon the input value, my desk is never going to be worth, $1 million, much less $1 billion. But with intangible assets, that is not the case, right? You can have something where you spend a relatively small amount of money on it and it is worth a huge amount. And you can have something where you spend a very large amount of money on it and you turn it into nothing, right? And that is extraordinarily problematic because we work in a cost-based accounting system. And so you have a scenario that is developed where the core inputs and the core most valuable assets to the business are essentially outside these financial statements. So coming back to, Fabio, your question about why has this happened, is that essentially over that period, companies went from their assets that mattered being things like, rolling stock and plant and equipment and inventory and big production lines and things. Those things, it's not that they're no longer important. It's that the things that generate economic value have shifted to other things like data and software and brands and regulatory approvals and a whole bunch of other things. And so the portion of those things is essentially increased relative to the asset basis of these
So it's
companies.
the shift to more the service economy in some sense.
Yeah, exactly. And what's happened as that's gone on, though, is that those assets are, because of the accounting standards, increasingly no longer on those balance sheets at all. And so what you see if you look at a company like, for example, Apple, is that you'll look at their market cap and then you'll look at their net tangible asset value. And there's this massive gap, an enormous gap. And you think, well, either the investors are all wrong, or alternatively, there's something that is in there that is not being captured in the financial statements. And in fact, for many companies, including Apple, and I haven't looked at the most recent filings, they don't even list intangible assets on the balance sheet at all. Now, that in and of itself is interesting because they're there. They're clearly there. Nobody's valuing Apple just for the sake of it. Like they're doing it because they genuinely believe it's more valuable. And it can't be in the physical assets because we know what those are worth. Those are on the balance sheet. So it must be in something else. And yet, because of the accounting standards, those things are not recorded at all. And so this presents an enormous problem and dilemma for investors because it means that modern financial statements are essentially becoming not particularly useful for analyzing company performance. And in many cases, the armies of analysts we see on Wall Street firms, their job is increasingly to unpack those financial statements and try to figure out really what is going on because the assets that are driving all the economic value are essentially absent from those statements.
It's something more than the difference between book and market value, correct?
An easy way to think about it is this. If you take a company when it's publicly traded, so we know what its value is, or at least what the market perceives its value to be, and we subtract off all of the fixed assets and all the financial assets, then by definition, everything that's left over must be intangible. And
Okay.
and it's those assets, because they belong to the company, and the company's putting them into operation, are the things that generate value and that are generating the market value of that company.
And I guess one reason you have a practice is investors aren't always good at valuing those intangible assets, correct?
Well, it's not just investors. The companies themselves don't always know what they
Right.
have. I mean, so yes, you're absolutely correct that investors, you could argue that, the market is, it's a weighing machine, right? At the end of the day, right? That they are quite good and effective at valuing these things, but they can't tell you what sits inside it necessarily. They can't say, well, this portion goes to brand necessarily, or this portion goes to data, or this portion goes to, patents or whatever else, right? But even management who have a front row seat to this are not always aware of the value of these things. And I'll give you a classic case of this. So, go back to 2020, COVID's hit. We're in the middle of the pandemic. Airlines aren't flying. United Airlines runs into a massive cash crunch and it needs to do something about it. Nobody's interested in loaning United Airlines money against its airframes, because who wants to end up with a whole lot of airframes as collateral it's got to park up in a desert somewhere? So somebody figures out that they have a whole lot of data in the Mileage Plus Air program. So they go out, and within roughly 4 weeks, they raise approximately $20 billion by securitizing the data in the United Airlines Mileage Plus program. Now, that asset is not on their balance sheet anywhere. It's not in their financial statements in any way, shape, or form. And yet they were able to raise $20 billion against it within 4 weeks. So, and there's many examples of that I can give you, of companies where there's tremendous value inside the business, but nobody really appreciates it.
Can I ask a trend that perhaps is going the other way around, and maybe whether you agree with me and what does it mean for for asset valuation, right? So if you take the hyperscalers, right? So the Microsoft, the Google, Meta, those are like by definition intangible companies, right?
Yes.
And some of the valuation factors are predicated on that being perceived as intangible companies. To run in finance and run the training their models, inference, they're trying to build bigger and bigger and bigger data center that costs hundreds of billions of dollars, reaching trillions in those cases. That at some point, whether they own them or not, I guess makes a difference, but generally speaking, makes them less intangible and more CapEx intensive, if you want. Is that a trend in the opposite direction? If that's the case, what does it mean in terms of valuation? Would they still try? Essentially, my question is, will investors still give them that extra premium because of being super intangibles or not?
Well, so in respect of specifically big data players, like people who are investing into AI, it's a really interesting question, right? To the extent that they need to own infrastructure to make this happen, do they end up looking more like utilities?
Right.
Possibly. There would be an analogy here if you went back to, say, the 1920s and the electrification of the United States, right? There may be an argument there to say, does ChatGPT look like some of the early energy companies in the United States? Because you've got this opportunity for massive market uptake of a totally disruptive technology, but you need an infrastructure to do it. Maybe
Right.
that's
The
what
number
they do
for
look like.
OpenAI, they're starting to sum up to hundreds and hundreds and hundreds to like getting close to $1 trillion, right? At some point, some
Yeah.
of those companies, they're not that intangible
Yeah,
anymore.
quite possibly. But what's intriguing is that if I go to the other end of the scale for just a moment, right, and I look at a company that looks very intangible, right, looks very tangible. Sorry. So let's give the example of a steel mill, right? The steel mill from the outside looks extremely tangible, right, in its quality. But let's imagine that I gave you a free steel mill. I go, here you go, Fabio. You have a free steel mill. The catch is you don't get to keep any of the intangible assets, right? So I get to hold on to, the software that runs the mill, or the data that comes out of the software, all the industrial know-how, the brand, all the customer supplier lists. And probably in the case of a steel mill, the most valuable thing would be the regulatory approval that allows you to operate the mill. What becomes very apparent very quickly is, regardless of whatever the accountants want to tell you, the steel mill is actually a liability. Like, the real value in the mill is the ability to run it safely and efficiently. And all of that is contained within the intangible assets, right? And so when I have those intangible assets, you can't run the mill, but I can take those intangible assets to a new mill and I can run them. So maybe the answer to your question in respect of, does OpenAI end up looking like an infrastructure play? Possibly, but even an infrastructure play, it's mostly about the intangibles. Because if I don't know how to run data centers, if I don't have a regulatory approval, if I don't have relationships to purchase electricity and power and so forth at particular prices, I got nothing. And so this is the thing. I mean, we talk about this idea that, software has eaten the world. Well, actually, intangible assets have eaten the world. They're absolutely everywhere now. And there's very few companies that aren't reliant on intangible assets. But we have this problem, which is that they're essentially absent from financial statements.
It's a really interesting case you brought up, Fabio, because I'm thinking of Amazon, which has Amazon Web Services, and which probably does involve big investments in assets. So does their whole logistics apparatus. And yet we think of Amazon as a great service provider, not necessarily as this asset-heavy company. It's all about services, right?
No, look, absolutely. And this is the thing. If you run that little thought experiment that I just did, you just say, okay, well, what are the assets that we actually need in order to utilize these assets, in order to utilize or extract economic value? What you inevitably end up coming back to is it's about the intangibles, even something like an oil well, right? You can't do, you need to first know where the oil is. How much money do oil and natural gas companies invest into figuring out just where the oil is? And then you need to know how to extract it. And then you need the approvals to be able to extract it. And then you need the knowledge of how to transport it and then refine it. And all of these assets, all of this physical infrastructure only derives its value ultimately from the intangibles. And yet, again, because they're outside these financial statements, we don't take anywhere near as much notice of them. If you drive past a big oil refinery, it's the physical asset that attracts your attention, but we don't see everything that sits behind it and below it.
Can I ask
Essentially.
you a question on the type of finance and the increased role the intangible play may have in terms of the type of finance that is going to be associated with this, right? You mentioned the United case during COVID. It seems like securitization is the vehicle that you can actually repackage some of these intangibles and provide value in terms of financing. How much of that is a driver of that specific way of raising funding, the securitization market?
Yeah, securitization is still relatively limited. I mean, the main method of value extraction for most intangibles today is through an operating vehicle, all right, by putting them into operation. Essentially individual or discrete monetization or securitization of assets remains relatively rare. So you do get instances, for example, where people will buy and sell patent portfolios. You get instances, of course, where people will license brands, or license properties like content or sports teams or whatever else, right? But that kind of discrete, individualized extraction is not that common, practically speaking. It's much more common that you will see a company assemble essentially a collection of assets together and then put those assets to work in a way that generates an upside, some kind of additional economic value. And, the classic is that if you look at Apple, right? So there's a model that we developed it looks at 12 different classes of intangible assets, right? And so those are patents, brand and reputation, design, content, software, genetic materials, approvals and certifications, data, competitive information, know-how, relationships, and network effects. 12. Apple's got 11 of those 12, right? In order for when Apple deploys its products and services, it's essentially leveraging a constellation of 11 different kinds of intangible assets. And those 11 different kinds of intangible assets create an incredible, what Buffett would talk about as a moat or intrinsic value that enables it to deliver its products and services into the marketplace and earn super margins relative to its competitors. And it's only ultimately able to do them because of those intangibles. I mean, everybody knows it's not its big donut building in Cupertino, right? It's not its physical infrastructure, its desks and chairs. It has nothing to do with that. It's all of those assets that ultimately count and what enable it to do it. And it's that assembly of that constellation is the way that most companies extract value from it. There are, as I said, exceptions, but that's the primary way.
Can I stick to finance for a second? I have a question for you. So there's been this surge in M&A deals this year, right? Between very easy financial conditions, expectation of deregulation in the financial industries. Well, we have seen M&A, IPO coming back. How does, mechanically speaking, when you do mergers and acquisition, how do they account for or lack to account for intangible assets?
Yeah, so honestly, it's relatively simple. They will, let's say you go to acquire somebody for 100 million. Just make this easy. And when you make that acquisition, you will look at what percentages in cash and fixed assets, and essentially that will be moved onto your balance sheet at whatever you acquired them for, and then there'll be a big gap, right? So in a classic, but if we take my general proposition, the S&P 500 is 90% intangible, you'll find 10% of it might be in the cash and the physical assets. Then you'll have a lump, $90 million, that will be sitting on your balance sheet as goodwill. Now, it's a little bit more complex than that because occasionally you can end up with what you go through a purchase price allocation exercise and you'll divide it out. But you would not divide those assets out into those 12 buckets I just described. They're more dropped out into a series of accounting buckets that are used by accountants to determine things like depreciation rates, etc. But fundamentally, it all sits under this notion of goodwill. Now, that goodwill can be depreciated, but it cannot be appreciated, which is a crazy situation, which means you acquired this company and you can do a great job of growing its brand and building its customer base and things, and that will never go up, but it can go down. And so this is it's a reflection of the same problem that we have, which we kind of got away with back in 1975 when intangibles were only 17%, but now it's 90%. It actually creates some very significant distortions in the economy, and they ripple through into all sorts of different places, from microeconomics to investors through to macroeconomic conditions as well.
Can I, just for ordinary viewers of this podcast, intangible asset is different than brand. Brand expresses some kind of value, but it seems to me it's more intrinsic than just a brand. I'm going to cite an example here. Before the podcast, I was looking at the way Ferrari is sticking its name on fashion. Like, you can buy Ferrari shoes. Well, sometimes that works and sometimes it doesn't. And it just sticking the Ferrari brand on a pair of canvas tennis shoes. Okay, but it's really not the intrinsic essence of Ferrari, right? That just really is just selling some small piece of value to licensing it out, correct?
Well, brand, or as it's protected via a trademark, right, is just
Yeah.
one of 12 assets.
Right.
The Ferrari brand is not what made Ferrari great, right? Great products build great brands,
Right,
And
exactly.
so there were a whole lot of things that went into making Ferrari great and building a great brand. And then that great brand can be parlayed into different things. So obviously it can be utilized in terms of the sale of the car itself. Would you, if you had the money, pay the same amount for a Ferrari if it was unbadged versus it was badged? Of course not. You're going to pay more for the badged version of the Ferrari. Are there some people out there, I'm not saying anything about you, Fabio, who would buy loafers with a Ferrari brand on it?
Be careful there.
I mean, I don't know, but clearly there is a market for it. Just like
I
there was a
may
market.
have a few, so careful.
So, just like, Caterpillar did the same thing with clothing. Caterpillar discovered that there was an opportunity for strong, hard-wearing work gear that was branded Caterpillar. Is somebody who wears Caterpillar shoes or boots going to go out and buy a Caterpillar tractor? Maybe, maybe not, but they're making additional value from it. They're extracting additional value. And it's just one of the assets, one of the 12 assets, a powerful one, but it's only one of the 12. And it's also, they all work together. It's very rare that you'll find a brand that explodes without any kind of other intangible assets supporting it. And this, by the way, is one of the problems, is that from a financial perspective, people will say, okay, well, there's this many intangible assets, but they have no idea how to interrogate what is within that stack. They can't really tell you what portion goes out to brand versus data versus software versus know-how or virtually anything else. There has been historically no ability to break down what's inside that thing.
Can I take a slightly different angle in terms of, like, you talk about this longer term trend, rising intangibles since the 70s. Fast forward to where we are today, can you walk us through how to think in terms of, like, how digital technologies, whether this is AI, whether this is blockchain technologies, how they will affect the creation of intangible and also the protection of intangible in some sense, right? The blockchain technology.
Yeah. So I think that even at 90%, I mean, we're approaching the asymptote, right? Essentially, with intangible assets. But And you can't completely divorce yourself from the real world, right? Totally. We still rely upon goods being delivered. Paris still needs 3 meals a day, right? There's still an extent to which these intangibles need to make their way out into the real world and deliver real world outcomes for people. The lights still need to turn on, etc. But my personal view is that we're only going to continue to see a greater and greater and greater emphasis on these assets as they become more and more and more and more important fundamentally, right? If we look at things like AI, if we look at blockchain, if we look at the digitization of just about everything, we can see that effectively it's almost impossible to achieve scale and speed without these things. And they are fundamentally intangible. So, well, if you own a piece of land, for example, and somewhere within that piece of land is oil or gold, you could do it the way they used to do it and drill dozens and dozens of holes randomly looking for that gold, right? Or you can run, radar or whatever sonic probes, etc., that they use these days to figure out where that stuff is, and you're going to find it a whole lot quicker. And with AI, you'll find it quicker still. And that advantage, that quickness, is the thing that's going to separate people from the winners from the also rans, right? So even though there's clearly always going to be a relationship of these intangibles back to the physical world in order to deliver the products and services that we all rely on every day, in order to do that at scale and at speed and at margin, you must be leveraging intangible assets. And the real trick is, the way to know this is, you go to any company pretty much at all and you say, hey, just try not using your intangibles just for a day. Don't use your data for a day. Don't use your customer or supplier relationships just for a day. Don't use your brand for a day, right? Don't use software for a day. And the whole thing collapses. I mean, look what just happened with these Amazon web server outages. Just the last couple of days. People went out of their minds, right?
My kids were very happy because Canvas wouldn't load, so they couldn't do their homework, actually.
There's always winners and losers, right? But the point is that modern business is 100% now reliant essentially on the exploitation of intangible assets. And that's a good thing, but it's a real problem when the financial markets have no effective means of valuing them or understanding what is there.
Maybe we can close. I have 2 questions to close. One at more a firm level and one at the bigger picture from a policymaking perspective. Like, from a firm level, maybe what is your advice to management of firms in terms of how to manage intangibles? Like, what are the common mistakes that CEO may be making? What would be your advice in terms of the firm, the culture that goes with it inside the firm? And then at a bigger picture from a policymaker perspective, briefly, how you think that you should rethink taxation, investment incentives, and close with that.
So at the individual firm level, what I would say is that C-suites and boards need to sit back and say, if we accept if we either accept the S&P 500 data, right, 90% of our values and intangibles, and or we simply run this thought experiment, right, could we stop using these things tomorrow? What becomes clear, very apparent, is that most of my value and most of my risk is in my intangible assets. And if that is the case, then we need to start asking ourselves questions like, well, do we even know what they are? And most of the time they don't, because they're off balance sheet, they're not on a fixed asset register, they're not on a risk register. Nobody really understands what the heck they are, right? So you have what are the implications if most of our value is in these assets and we don't even know what they are, we don't even know how they're protected, we don't know what they're worth, we don't know how they're managed. And it comes back to Peter Drucker's famous, dictum, right? What gets measured gets managed. If it's not measured, it's not being managed. And most companies, in my experience, when you sit down with them, they come to realize that they're not managing these things very effectively at all. And that leaves them exposed to serious hidden pools of risk and also material hidden pools of value that they're not exploiting. The example of, United Airlines being one case. And there are many examples like that. So that's what I would advise at a micro level, is to say, you need to understand what these assets are, and you need to understand how to value them and how to manage them. At a macro policy level, I think that there is a very significant issue here around, and it reminds me of the way in which measuring things by GDP, by the GDP yardstick, can lead to distortions, right? Is that when we live in an economy where 90% of the value is no longer being effectively tracked or measured, that creates very significant distortions. And I'll give you just one quick example of this. If you look at, through the 80s and 90s, there was an enormous run up. If you look at the chart from 17% through to 90% today, there were two big jumps in the late 80s and early 90s. And there were two drivers for that in terms of why intangibles became a lot more valuable. And one of that was digitization really got going. And the second was when a lot of US companies outsourced production to China. They went, okay, we do three things: design, manufacture, sale. This manufacture one is a fool's game, high inventory costs, high volatility. You trade at discounts on the exchange. We'll get rid of the manufacturing. We'll push that to China. We'll just do sales, and we'll just do design, and we'll do sales, and it'll be great. We lightweight the balance sheet. We look like heroes. And they did look like heroes temporarily. What they didn't realize is that in the process of this, they had essentially transferred vast amounts of intangible assets into China. And so through this process of outsourcing, we had essentially passed to China massive quantities of intangible assets and IP. Roughly, they estimate about 400 billion to 500 billion per year for 20 years, which was about a third of the value of all the gold mined over that period, right? Per year. Now, if somebody had been walking off with a third of the value of all the gold mined every year and had been transferred out of the Federal Reserve at Fort Knox, somebody would have noticed. Somebody would have said, maybe this isn't such a good idea. Maybe, or if somebody a CFO had to sign off on the balance sheet and say, we are transferring $300 million worth of IP from ourselves to China through this process, somebody would have said, let's just stop and consider that for a moment. Is that a good idea, right? But because they weren't on financial statements, nobody did do that. And those kind of implications have been flowing through the economy now for 25 years. And I think that a lot of people, if they put hands on heart now, would say, maybe it wasn't such a smart move, what we did. And it's because it was essentially invisible. So that's one example at a macro level, how the absence of these things creates a problem as well.
I think the strategy was a little bit more, we'll give them this low value tech, and we'll suck the cash off, and we'll reinvest into high value intangibles like design or whatever it is. Whether that really happened, I don't know, but it sure did advance China's ability to start copying and making its own tech and then quickly move up to scale into higher tech stuff.
There was also assumption on their ability to retain IP, right? Even though you were outsourcing somewhere else.
And by the way, just so we know here, the Chinese were far from stupid about this, right? Most of the time in China, if you wanted to do a deal, part of the conditions and terms is you had to leave the manufacturing IP in the country. And the European Union has just in the last week announced that it's going to impose new restrictions on China's access to the European Union, such that Chinese IP to gain access to the European Union will need to be transferred into the European Union.
Yeah, there were different structure like joint ventures and a bunch of stuff where essentially you were transferring IP.
Yeah, and so what we're seeing is the rise of new mercantilism, essentially, but the currency's intangibles. Because fundamentally, that's the real value, right? And one of the ways you can know this is that, there's cyber and hacking that goes on every day, for example, but the real value is an industrial espionage. They're not. Sure, people are stealing from granny's bank account. That happens. It's a terrible thing. But a lot of value is actually in companies stealing intangibles from each other, right? And the story of China's rise is in part the story of large amounts of transfer of knowledge from the West into China, which, by the way, is the same story that happened to the United States, just to make it very clear, to make this is not a China bash. that the US was the biggest pirate nation in the world in the late 1800s. It didn't respect UK copyright. It didn't respect UK patent law. It ripped those, they would load whole ships full of books out of London, sail them across the Atlantic, copy them wholesale in order to get its publishing industry started. So the wheel turns, there's a new villain, right, etc.
Paul, I have a concluding comment. I noticed in your list of 12, you didn't mention people. So I have a son who works for a startup, technology. Rows, he works out of Huntington Beach. Rows and rows and rows of high-level engineers sitting next to each other. The VCs, the biggest VCs in the Valley are involved in this company. The assets are these people right now developing this intellectual property. So aren't people part of this whole process, and how do you value that?
Here's the reality, right? When you employ smart people to create you're employing smart people to create smart things, right? That's what you're doing. You don't employ smart people to create dumb things. You employ smart people to create smart things. Those smart things are intangible assets, right? That's what they are. Great brands, great software, great data, whatever it is, right? If you could get those smart things without the people, you would, because people are a pain in the neck, right? People are, the wetware is the problem, right? And that's what AI is. AI is taking out the middleman, right? AI lets you go directly to the smart things without the people. And that's actually what's going on, right? Intangible assets. What do you feed into an AI engine? You don't feed physical things, you feed intangible assets. And what do you get out of the AI engine? You get intangible assets, and which means you've cut out the person in the middle. So are people intangible assets? No, they are producers of intangible assets. And if you can get those intangible assets out, the people, you can. Just like if you could get cotton without somebody spinning it on a wheel, you will. It's no difference.
I don't know, Fabio. We better stop here, because I think if we had Myron,
you and I are
Scholes
gonna get
Paul,
fired here. There would be someone else doing this podcast soon.
There'll just be an eye like Hell 9000 interviewing us.
I think if we had Myron and Paul on the same podcast, it'd be pretty contentious. Because Myron thinks that there's something, he calls AI a farmer. It's not a hunter. It's really not out there finding the novelty, the creativity.
I 100% agree with him, actually, on that point. AI, at the moment at least, he's right. It's a hunter, and it is a replicator, and it's a probabilistic engine. And like all innovation occurs at the margins, and AI is not very good at the margins. It's good at replicating and probabilistically determining what has come before. And we know that progress always occurs at the margins. So for the moment, the truly smart people who are coming up with the truly smart stuff, the Picassos, the Mozarts, right, the Steve Jobses, etc., that's safe. But the stuff in the middle, the dross, that is in trouble.
This is why it's such an interesting part of history. Like, it's a confluence. On one hand, you have the AI that is going to commoditize what's in the middle, essentially. But you're also in the middle of a regime change from globalization to something else. Those things that happens twice in a century, and no one knows where the new roads of finance and economy will lead us. The AI will not be able to take you there. This is a regime change. They are now doing the regime shifts. So there is still a role for us, Craig, essentially, as long as we close this podcast quickly before Paul get rid of us for good.
All right. Well, thanks very much, Paul Adams. Again, he's leads Anderson Consulting's practice in intangible assets and value for companies. Thank you very much. This is fascinating. And I'm sure we're going to have you back on. This is just one of those subjects that's endless, if that's okay with you.
Look, I will be here with my Ferrari loafers on.